This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore.
So this week, fabulous guest with Michael Kitces joining us. And the advisors that are listening to us surely know Michael Kitces. He's a very high energy entrepreneur, author, podcaster, but also a financial advisor. So we reached out to Michael to join us because we thought he'd be a great guest for the investors out there that listen. And he's got a lot of great financial planning experience. So we had a bunch of great questions for him that he shared his answers with us today.
But the thing that's amazing about Michael is, I mean, you said it, Cameron. He's the leading expert, I think, possibly globally in the financial services industry, on the financial services business side. But meanwhile, in his spare time or something, I don't know, he's having papers published on retirement planning research.
I literally don't know how he does it all. I mean, he's a financial planning. He's the head of financial planning for Buckingham Wealth Partners. Like, people know Buckingham. We had Larry Swedger on, I think it was episode 30 a couple of years ago. This is a $50 billion firm. So he just transitioned his practice from the firm he was at over to Buckingham lately. But he's also an entrepreneur with a lot of other companies. I don't know how he gets the time. He co-founded XY Planning Network, which is an organization of fee-only planners dedicated to Gen X and Gen Y. Created or co-created a company called AdvicePay, which helps those fee-based advisors have a charging a fee platform. He also co-founded fpPathfinder, which is, I just discovered this recently, but it's an amazing tool for advisors to work on workflows for the financial planning advice business. He does a weekly podcast, which is often an hour and a half to 2 hours, where he interviews a leading advisor in the industry. And we'll give a shout out to your sister, Tessa, who works in our office. And Michael interviewed her on episode 161 of the Financial Advisor Success Podcast. It's amazing how much he does. And he's got a young family, which he talks about. It's incredible.
It doesn't make sense. He's very impressive. But as a guest on our podcast, the thing that was cool is that he's got all of that going on, the entrepreneurship, and he's able to speak. He's, like I said, the best person to speak about financial services. But then he's also an expert in retirement planning research, and he's spitting out data and evidence, best practices that tough to find someone with the breadth of knowledge within the space of financial services and retirement planning that he has.
And honestly, we could have talked for hours, both on the technical side. Like, we asked him some pretty technical questions, but also about the industry and the impact of what future trends are going to be for investors in this industry. So we could have sat here all day long chatting with him. It was great. So Michael joined us from his home in Reston, Virginia, which is a suburb just west of Washington, D.C., where he's based. And with that, please enjoy our conversation with Michael Kitces. Michael Kitces, we are so happy to welcome you to the Rational Reminder Podcast.
Thank you, Cameron. I'm looking forward to being here in the conversation today.
Yeah, so Ben and I have listened to you for years, of course, so it's a real thrill for us to get to meet you finally in an environment like this. We wanted to kick it off with some questions about your retirement planning research. Then later on, we have some questions around the business of financial advice, which you are certainly the resident expert on.
Appreciate that.
So off the top, can you describe how an early retirement affects the sequence of returns risk that many investors worry about?
All right, so we're diving right in.
We're diving right in. So a sequence of return risk is I kind of think as this mathematical phenomenon that when we talk about investing, knowing that markets are volatile and do crazy things from time to time, recent scenarios being a good example, that kind of the mantra in our industry has always been these things average out in the long run. And if you look at the research, like, they really do. The range of what markets do from month to month is crazy big. What they do from year to year is huge. What they do every 5 years is not as dramatic. What they do every 10 years is even narrower. And what they do every 30 years is really actually not that varying, right? Like, it's sort of like the rubber band effect. Even if the market snapped far one way, it tends to snap back to something that normalizes. And so on the one end, that's always been the comforting thought, I think, from the investing end and even from the retirement accumulation end. These things average out in the long run. So we say stay the course, stay invested, allow the markets to come back, right? Worst thing we can do is a big dramatic sale because we're concerned at a market bottom. But that math of these things average out in the long run doesn't actually quite work the same way when you're taking money out of a portfolio, when you're in retirement. When you're taking dollars out at the same time that markets are moving and volatility is occurring, in sort of the logical extreme, you can run the risk that you take so much out while things are down that by the time the market finally bounces back, you don't have anything left to participate in the bounce back, or at least you don't have enough left that when the bounce back finally comes, you don't have enough gas left in the tank to get to where you were going. And so this phenomenon that once we start taking withdrawals, the returns can average out in the long run, but if you get a bad sequence, you might not have enough money left when the good returns finally show up, has been dubbed into the sequence of return risk phenomenon. And quite literally, I mean, it creates scenarios where if you just look at different time periods in history, like I can take the same sequence of withdrawals and start in like the 1980s and finish with millions of dollars. Whereas if I do the exact same thing, but I started in the 1970s, which in the US was a very difficult decade in the markets, I can go bankrupt starting in the 70s with the same pattern of spending that lets me finish as like a multimillionaire in the 80s, solely because the first decade, not even just the first year or two, like the first decade was so dramatically different. In the US, we basically didn't have a dime of appreciation for the span of 10 years through the 70s, while markets more than doubled through the decade of the 80s. And if you're taking ongoing withdrawals, that can be the difference between I've depleted so far I can't recover, and I'm actually so far ahead in the good scenario that you can hit me with a horrible decade. I can't even run out of money at this point because I'm so far ahead.
One of the ways that people can deal with that is with variable spending as opposed to spending a straight line, including when markets are down, obviously. Can you talk about some of your favorite variable spending rules?
Yeah, so it's interesting when you think about the ways that you can deal with this. As I kind of overgeneralized a little, there's sort of 2/3 ways that we can deal with this. The first, and we may talk about it more later, is like I can change stuff in the portfolio, right? I can risk manage, make adjustments, maybe buy and invest in different things, maybe invest more tactically as I'm going. Like I can change the portfolio in response to the markets to try to manage this. Option 2 is I can change what I'm spending in the first place to deal with this, right? It's sort of the proverbial, like when times get tough, we'll tighten our belts a little bit. Now, what we find from the variable spending end in particular is that there really are a couple of different ways that you can go about this, and even some of the sort of rules of thumb that people think about as a way to deal with this aren't actually good ways to deal with this. So the most straightforward way to do this, frankly, is we just spend really conservatively. We spend so conservatively. I think even something bad happens, we'll weather the storm. And if the worst case scenario is if bad stuff happens, I'll call you in a couple of years and tell you can spend more. Which for some people, like, great. Spending cut, bad. Spending raise, good. So just tell me how far I got to ratchet down to be at a safe baseline level, and we'll figure out how to ratchet up later if and when the markets deal that to us. And broadly speaking, that's a whole body of research called safe withdrawal rates. We generally find this number around 4% of the starting balance. So like $20,000 per every $500,000, $40,000 per every million. You take that number, you adjust it for inflation, and even when crazy stuff happens, markets tend to average out in enough time that you have enough left for when the recovery finally shows up. So option 1 is sort of, it's not really a variable spending rule, but it's be so conservative you won't have to vary, at least to the downside, and you only have to make upside decisions when you get there. And you can even create sort of straightforward safety margin rules. I call these ratcheting rules. Like, look, if your portfolio ever gets up 50% from where you started, you have built enough of a margin that even if there's a pullback, you're still so far ahead, you can have a raise. So if you get up 50% from where you started, take a 10% raise. Every 3 years, we'll check in. If you're still that far ahead, keep taking raises as long as you got your safety margin. So one version is spend conservatively, ratchet higher as we go, but try to keep it conservative enough that if bad stuff happens, I don't have to cut my lifestyle because I don't like cutting my lifestyle. The second version of this are what I call guardrails. Some people also call these decision rule approaches. Think kind of an if this, then that approach to how we're going to handle it. I like to explain this to people as, because I've got little kids, think bumper lanes at the bowling alley. We have them in the US. I'm presuming this is a phenomenon in Canada as well. I've got 3 little ones. And so when we take them bowling, these little like bumpers come up on the lanes so that the ball can't go into the gutter. When I was young, they actually had like giant inflatable tubes they put in there. Now it's all electronic. So these like little gate barriers come up and block off the gutters, and then the bumpers go down when the adults go, unless the adults want to be conservative, and then you get the bumpers on the adult lanes as well. So when my daughter goes to bowl the ball in a bumper lane, right, one of 2 things happens. She either rolls the ball fairly straight down the line, it rolls all the way down, it hits the pin, she gets all excited, does her little victory dance. Or she rolls the ball slightly askew, it drifts off to the side, heads towards the gutter, hits the bumper, bounces off the bumper, goes back into the middle lane, hits the pins. She is equally happy because she got the outcome that was desired, couldn't care less that it happened to bounce off a bumper. All that matters is we got to the end the way that we wanted to get to the end. And so you can do the same kind of approach with a spending rule approach in retirement. So it says, look, maybe I'm going to start by spending a little higher, because if there are bumpers, like I can start a little higher. I just might hit a bad bumper that makes me cut. So maybe I'll start my spending at, say, 5% of my portfolio. If things go really well and my portfolio outgrows my spending, my withdrawal rate will get lower because the balance is going up more than the money that's coming out. It's like I might start at 5, then it goes to 4.8, 4.5, 4.2. So if it drips under 4, I hit the conservative bumper, which says I get a raise. It's like if you start at 5, but it drifts down to 4, you get a 10% raise in just real dollars effective today. Your $50,000 withdrawal goes to 55. Now we can put a bumper on the other end as well. So if your spending outpaces your portfolio, or you have a big market decline, so suddenly your spending is a bigger chunk of your portfolio. If your spending starts going up from 5 to 5.2 to 5.5 to 5.8, you're still within the bumpers. But if your spending rate goes over 6, you have hit the bad bumper. The bad bumper requires a 10% cut. So your $60,000 of spending gets chopped down to 54. So I can't tell you which bumpers you're going to hit. Right? I do not, unfortunately, have the fully functioning crystal ball to tell you which bumpers we're going to hit in the future. But I can, in the most literal sense, give you a plan, a set of variable spending rules that says if you hit the 4% bumper, you get a raise. If you hit the 6% bumper, you take a cut. If you stay in the 4 to 6 range, you are in the lane and you can roll the ball straight to the end where like that. You don't need a bumper. And so I don't know which bumpers you're going to hit. I don't know if you're going to do it like my little boy and try to like curve it off a bumper and wing it into a bumper and make it bounce a couple of times there, to each their own. But what I can tell you is that we put bumpers in place, so there's no gutter balls here, right? You're not going to spin so far off the tracks that you're going to run out of money. At worst, you'll hit a bad bumper more than once and have to take more than one cut, but eventually your spending will come down. But we don't have to quite do it at the extreme of like, okay, the market was up 6% this year, so you get a 6% raise. And the market's down 12% next year, you get a 12% cut. Because if you just immediately translate all market changes into spending changes, for most of us, it's a level of spending volatility we can't really manage, right? I can't say like, Cameron, I know I told you 2 years ago that you could buy that dream retirement home, but the market's down so much in the pandemic that you'll have to sell it. And then I call you back 2 years later. I'm like, market recovered. You can buy the house back. And you go, well, I can't. Like, I sold it to someone and they like living there now. Like, I can't go get it back after a 2-year temporary spending cut. I need a little bit more stability. And so the idea of guardrail strategies or doing bumper lanes is not just that we're setting where the bumpers are so that we don't veer too far off course. It's also actually so that we set the bumpers wide enough that we don't have to constantly be changing our lives and our lifestyles. We only make the adjustments when the magnitude is big enough that it actually matters. The third adjustment I'd give quickly as another way to think about variable spending. One of the things that we see most commonly, just I'm part of an advisory firm as well. I've sat across from clients for a long time. One of the things that we commonly see with people is I think of it as like the tighten your belt phenomenon, or you're like, times are tough right now, markets are down, I'm gonna cut 10 or 20% out of my budget for the next 2 years until these things bounce back, and then we'll try to get back on track again. And I certainly can appreciate that. I think it's an instinctive response for a lot of us. When times are tough, we tighten our belts. The irony, though, is that when you actually look at the retirement research, it doesn't help very much. When we're only spending 4 or 5% of our portfolio in the first place, and you cut your spending by 10% of that, you're talking about a spending cut that might be 0.4% of your portfolio. So if you do that for the next 2 years and you shave off 0.8 of your percent of your spending, like, you can make that up in one good day in the markets. Like, it's just, the irony is it's very impactful for us personally, and actually does almost nothing to get the portfolio back on track because it's not actually high enough impact over a long period of time. The alternative that we find that actually works better, so I call those large but temporary cuts, right? Like, I'm going to take a big cut, 10 or 20% out, but we're only going to do it temporarily. What we find actually works better is not large temporary cuts, but small permanent ones. So think, instead of I'm going to cut my spending by 10 or 20% for the next 2 years and revert it back again, I'm going to just give up my inflation adjustment over the next year. So, I normally, my spending goes up by 2 or 3% a year. I'm going to give up my 2 or 3% a year raise. Now, in general, we don't think much of that. I mean, in practice, working with clients, we've never had someone that's like, hey, we live a great lifestyle with $10,000 a month, but inflation just came out and it's 2.7% a year. So please change my monthly distribution to $10,270. Right? We don't really do that. Like, we spend what's in our bank account. Now, if we work with our clients and say we're going to adjust your spending every year for inflation, if I increase their spending distributions that's going to their account because that's our plan, they spend the money that's in their account. And if we don't increase the distribution, we spend the money that's in our accounts. It's pretty straightforward. But when I look at this over time, if I just trim like a 3% inflation adjustment out, not only does it mean you don't lift your spending this year, it means your baseline spending is now ever so slightly lower for every future year as well.
Yes.
Because if I lift your spending up, that compounds. If I don't lift your spending up, that compounds. And so if I just take out 3% inflation adjustment writ large over 30 years, the impact of that is actually 5 to 10 times more beneficial for your long-term retirement than doing that small but permanent cut for 2 years. And so the irony is it's both 5 to 10 times better for the longevity of your portfolio and hurts far less. Like, we barely even notice the inflation adjustment that doesn't happen. 10 or 20% cut for my spending for 2 years, like, I'm going to notice that. That's a lifestyle change. And so the third way, I think, just to think about this overall, like, number one is we can set it so conservatively that we're just only going to ratchet higher with good news because I don't like cuts. Option two is guardrails. Like, you got to be prepared for the bad guardrail and the good guardrail, but like, we can put guardrails in. I don't know which ones you're going to hit, but I know we can't veer too far off track because we got the guardrails. And option three is more of a, we'll try to lift up our spending when times are good, but we're going to trim out inflation adjustments, or more generally, we're going to make small but permanent adjustments when times are difficult, because those actually have far more benefit than the large but temporary anyways, and they're easier to manage.
And it's been my experience with a lot of retirees that rarely does the increase happen like on a regular basis. Like, so many people are getting the same amount now that they were taking out 3 years ago, 5 years ago, even some like 10 years ago. It's amazing.
Yeah. I find there's sort of two effects that happen So on the one hand, we're actually getting a growing base of research in the retiree world. I know we're seeing some of this data in the US. I don't know if you're getting some of these studies in Canada yet, where researchers are starting to dig into big data sets of consumer spending, right? This is kind of the age of big data. So, there's some national government studies that have interesting consumer spending tracking for individuals over time. And ironically, some of the banks and credit card companies are doing this research because they have, tens or hundreds of thousands of people. So they can actually look at aggregate spending habits of people and map it like over time or directionally. And so what we find in practice is that in the real world, on average, people's spending doesn't keep pace with inflation with inflation in retirement. It lags. Now, it's not always steady. I find, at least with our clients, it's more event driven. We lived a more active lifestyle, but then someone falls, unfortunately breaks a hip, 6 months of physical therapy. They just don't like doing the big long trips anymore. So they do shorter trips, which are less expensive. And then like Pop's cataracts get worse. And so what used to be nice dinners are now like blue plate specials at 5 o'clock. And just like discretionary spending starts reining in as our worlds adjust as we get older. But the net result is that spending doesn't actually keep pace with inflation. And it often is much more level dollar, where inflation is actually means you can buy a little less, but it's okay because your life shifted and you're buying a little bit less anyways. The secondary effect I do see for some people, though, is that we manage sort of the intermediate term impact of inflation with just basically the bank and checking account. Like the money from my investment account to my bank account stays consistent for years, but I used to keep like a $30,000 average balance in my bank account. And then it's like 28, and then it's 25, and then it's 20, and then it's 15, and then it's like 8. And I call you up, Cameron. I'm like, could we like do a quick, like $10,000 or $20,000 distribution just to build the cash back up? And it's really what's happened is it's like 5 years worth of cumulative inflation adjustments that I take in one big infusion because I didn't really adjust the ongoing distributions. Yeah. I just did the catch up with my bank account as sort of the regulator valve along the way. So we do see that with some clients as well, where inflation actually is creeping their spending higher. They're just handling it in chunks as their bank account kind of builds a reserve and then winds down. Whereas others, just as we get older, lifestyle slows down a little bit, and spending actually isn't increasing as much in the first place.
So that's the spending side. You mentioned that there's also the portfolio side. Can you talk a little bit about, you did a paper with Wade Pfau that gets mentioned quite a bit online, which is the concept of a rising equity glide path, which is contrary to what most people think about when they think about retirement portfolios. It's getting more aggressive as you get older, specifically, I believe in the paper, in high valuation environments. Can you talk about that research?
Yeah, absolutely. So Ben, I think you hit on it well, right? The traditional view is as we get older, we get more conservative and we dial down the risk in the portfolio, right? We have sort of rules of thumb, own 100 minus your age in stocks or 120 minus your age, and just sort of a general view of like the older people get, the more conservative their portfolios would become. So the problem with this really goes straight back to the discussion earlier about sequence of return risk. So overgeneralizing a little, like markets go up and down, or they go down and up, right? Like I know they're going to be volatile. They're going to move up and down. In general, they move up more than they move down, which is why we get growth in the long run, but they do it in a volatile, uneven pattern. But what we know from the sequence of return risk research is that it actually matters a lot whether they go up and then down or whether they go down and then up. If they go up and then down, you actually get so far ahead during the up years while taking moderate withdrawals that by the time the down comes, you've compounded so much extra money that it doesn't even hurt that much, right? That's why if you retired in the 80s or 90s, you got so far ahead that as tough as the 2000s were, like you already had built up so much additional wealth in the 80s and 90s that wasn't going to ruin your retirement at that point. If markets go down and then up, it's different, right? If I retired in 2000 or the eve of the financial crisis, I was sweating it pretty hard in the first few years there, watching how much my portfolio dropped while I'm taking ongoing withdrawals and going, I hope this recovers soon, because if it doesn't, I'm going to draw it down so far that when it does recover, I won't have enough left. That's the sequence risk. So if you imagine these patterns, right, it goes up and then down where I'm far enough ahead, it doesn't matter. Or it goes down and then up and I got to really sweat it that I get the recovery in time. And then you overlay on this changing your equity exposure over time. So the traditional view is we start more aggressive and we get more conservative. So if I get the scenario where markets go up and then down, this works fine. I just make more money aggressively in the early years when the market goes up. And then later I get more conservative by the time the market goes down. But the reality is I didn't actually need that, because the reality is like you could be conservative all the way through. If you get a great bull market at the beginning, you're going to be so far ahead by the later years with compounding that just mathematically your retirement will not be in danger. It feels scary when you say like, hey, the market might go down a lot in your 80s, but it's just, if you actually start running some of the numbers, you get so far ahead, it's just not actually a risk of depletion. Now, if you get the bad sequence, markets go down and then up. So if you envision the traditional approach, we're going to get more conservative and we go. It's like, so let me get this straight. You're going to take all the risk while the market goes down. And then when it's finally ready to recover, you're going to own less in stocks that recover. So you bear all the pain and then give up the recovery. This is not good. And quite literally, in bad sequences, the traditional approach of decreasing your equities as you age amplifies the sequence problem. You bear all the pain and diminish the recovery, which actually just puts you more at risk in the first place. Now, when we flip this formula upside down, we say, well, what if we get more conservative at the beginning and more aggressive at the end? So in the good scenario, markets go up and then down. As long as you don't go hog wild like 100% in equities in my 80s or anything, you've still got some participation in stocks in the early years. Like we're going conservative but not out of the markets. You still get the growth in the early years. And while markets might pull back in the later years, if you get a little more aggressive, it's still not going to ruin your retirement, because you actually just, bull markets and early retirement compound extraordinary amounts of wealth to get you ahead. But if you get the killer, right, the bad then good scenario, the sequence risk scenario, if we start out more conservative and we get more aggressive later, then you actually reduce the pain in early retirement and you benefit more from the recovery that follows. So you get less pain and more gain. In the one scenario, you are at the greatest risk of needing less pain and more gain. And that effectively is why it works. Now, I know for a lot of people, it feels counterintuitive. There are some things to clarify just about this research. Like we didn't publish it saying, hey, like start out with your balanced portfolio and then go to 100% in stocks by the time you're in your 80s. This is more like if you were comfortable with a traditional balanced portfolio with, I don't know, 50% in stocks or 60% in stocks, it's like, how about you own just 30% in early retirement? And then by later retirement, you just go back to the 50-50 portfolio you were going to own in the first place. Like, we're not talking about dialing people above what they're comfortable with in the first place. It's more of the point that wherever you're comfortable, that's where you get to after you've been in retirement for a while, but you're more conservative at the beginning so that you don't get derailed with the badly timed sequence. The other way to think about this that I find actually for most people is just more intuitive, is to think about this in reverse, right? So my stock exposure is also essentially 100 minus my bond exposure. So if I think about this in terms of bonds, here's basically how it plays out. Because you're at most risk early in retirement, instead of owning 50% in bonds, we're going to own 70% in bonds. So we're going to take like an extra 20% and we're going to build you a little tent for safety. I actually call it a bond tent with some people. So we're going to shelter in the bond tent for the next 10 years. And over the next 10 years, we're going to spend the bond tent down. And as you emerge out of the bond tent, you'll go from 70% in bonds back to 50% in bonds because you used your reserves to get through the early sequence risk. And by the time you get back to normal, you're just going to move forward with the portfolio you were going to have in the first place. Now, again, build a 20% bond tent and spend it down is actually just the same thing as get more conservative in stocks and own more later. It just feels a little more natural to say we're going to spend down the bond tent as opposed to saying we're going to buy more in stocks. It's really mathematically opposite sides of the same coin. But I find that sometimes it's helpful to think about it in those terms. Just you build a bond tent in early retirement, and once you get through the sequence danger zone, you can come out of your tent.
So I'm really curious, Michael. You've shared with great enthusiasm many excellent ideas here. I'm curious how you suggest to listeners to manage this. Like, many people are familiar with an investment policy statement, which is widely used and widely known and often used to manage money in the accumulation phase. Do you also recommend some sort of withdrawal policy statement so someone can decide what works best for them, so it gives them their own guide going forward on the drawdown side?
I am a fan of the withdrawal policy statement approach. Now, I'll admit, like I recently changed firms in the industry. I've not gotten us to implement this in our firm yet, so on my list of things to work on. But I'm very much a fan of the approach. The idea of it at the end of the day is, and I'll knock our industry a little bit. I love my financial advisor world, but I got to knock us for a moment here. Like, we love to talk about financial plans and having a plan. But I find at the end of the day, the plan for a lot of us is stay the course, stay invested, meet with us on a regular basis, and we'll tell you if anything needs to change. Which is, like, it's a fine thing to do. It's great to have someone who's along with you on the journey, who can give you guidance about how to make adjustments along the way, right? Like, ships going through stormy seas have always had a navigator who's separate from the captain, because it helps just to have someone else who's looking at the big picture to make sure that we're steering the right direction. So I'm all for that navigator kind of role. But in the most literal sense, it's not really a plan. It's just I'm going to be here to help you make the decisions when the stormy seas come. We don't actually have a plan for the stormy seas. I'm just going to be with you to help you when the stormy seas come. I'm increasingly a fan of withdrawal policy statements, because at their essence, a withdrawal policy statement is a plan, is an actual plan. Like, we're gonna put you in guardrails. Here's where we're gonna draw the guardrails. If something happens, here's what adjustment we'll make in response to the guardrail. Now, we frame these as policy statements because at the end of the day, it's kind of literally, there are a series of policies that we will implement depending on what happens. I still don't actually know which policies we're going to run with, right? I don't know which guardrails you're going to hit, or if you're going to hit any of them.
Exactly.
But we have, in a very literal sense, a plan, like a written plan. We have both made sure we're on the same page about of how we're going to handle this. And I think what you're going to see in the coming years is more and more advisory firms adopting this kind of approach. Because again, I think just it's actually much more comforting at the end of the day from the retiree end, just to know there's a plan, not just a navigator to help, but a plan in place. And frankly, from the advisor end, just it's easier to make the evaluations of what to do in the moment when we're dealing with these situations, because we have a plan and everyone's bought into it, right? I don't have to give you the bad news that, hey, markets are down enough that you're going to need to trim your spending. You know that because we have a policy statement with math that anybody can do. Now, I'll help you figure out, how are we going to express that spending cut? And do we need to make a little bit more of a spending cut, or is there an exception as to why we might do a little bit less because you've got mitigating circumstances? And here's another factor to this that you're not thinking about. So I still think there's absolutely value for the advice that we're going to infuse into that process as well. But, at the end of the day, just I think everybody sleeps a little better at night having a plan. Not that plans don't change as the world happens, but it's still easier to have a plan than to not have a plan. And the withdrawal policy statement to me is the essence of what a plan is. I can't spell out exactly what's going to happen because I don't know the future, but I can set a series of policies. If A happens, we'll do B. If C happens, we'll do D. And then I'm going to go along with you on the journey, and we'll figure out whether A or C happens when the time comes, and how we're going to address it on the spot.
Yeah, I really like that idea. It captures the most practically important part of retirement planning. Yeah.
And I think just it helps, I've lived the other end of this with clients that we work with. It's like markets get volatile. And I'm thinking of a particular client situation we went through in like my early career days in the 2000 to 2002 bear market. His name was Jim. And so we had this series of calls for a couple of weeks right around 9/11 and the market volatility that happened. Our markets closed for an entire week. And so I get a call from Jim, like, I'm really freaked out about this stuff. Do we need to sell? Do I need to make any changes? Like, no, Jim, it's okay. He calls back a week later, market's down a little more. He's like, do we need to do anything? Like, no. I told you it's okay. Like, we're okay. It didn't move that much. The market drops a couple more points. Jim calls back 8 days later. Now, do we need to do something? Like, no, it wasn't that much of a move from where we were. And I didn't see this series of 4 calls with Jim over the span of 6 weeks. And what I realized was going on was, everybody gets at some point, it will be so bad. Like, the markets have fallen so far, the world has changed so much that Jim's going to make that call and he's going to say, how bad is it? Do we have to change? They're going to be like, oh, Jim, oh, I'm so sorry. It's awful now. Like, your retirement plan's toast. The vacations are gone. You're probably going to have to sell your retirement home. Like, this is awful, man. I'm so sorry. Right? Like, at some point, it'll be that bad. We hope it never gets that bad. But at some point, it could be that bad. And the problem that we were stuck with was Jim had no idea where that line was. So he did what any rational, normal person would do. He just kept calling, like, are we at the line now? 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 And I had never really figured out how to have a conversation with him of like, here's the line. Like, look, you have $800,000. Frankly, as long as you're above 600, your spending is fine. So this bouncing around from 720 to 750 back to 700, you're still way above your line. I mean, I know it doesn't feel good to watch the bouncing around, but like, you don't need to keep calling. Like, here's your line. You're way above your line. And frankly, even if you hit your line, we can write it in the withdrawal policy statement. Like, what are we going to do? 10% spending cut. Let's even talk about how you would do that. Okay, we'll cut a vacation. We'll rein in the restaurant budget, whatever it is. And so I think part of the challenge that we have and that withdrawal policy statements help to solve for situations like this interaction with Jim is just we finally know where the line is about what's bad and what's not bad, because most of us we don't intuitively know this. There's nothing obvious that says like, here is the magic line in your portfolio where your life has to change versus not. And so withdrawal policy statements help us encapsulate that. And the traditional approach, I mean, I don't want to knock it too much, what I've done for most of my career, but it's like, I feel like the traditional approach is a lot of, I so promise I'll be there when we have to make adjustments. But Jim never knows when the adjustments are coming. So he just keeps calling me and everybody is stressed.
So we've mostly been talking about maybe not quite including the withdrawal policy statement, but we started off talking a lot about the quantitative aspects of retirement planning and how we can optimize that through different spending rules and different asset allocation rules with withdrawal policy statement kind of non-financial, at least documenting the quantitative portion. But anyway, what about the non-financial errors that people can make when they're doing their retirement planning? Can you talk a little bit about that?
Non-financial errors in what context?
I've read some of your stuff where you're talking about things like people setting aggressive retirement goals, working in a job that they're miserable in to retire to do.
Yes. One of my I was going to say pet peeve, but that probably understates my my frustration or aggravation with this. I feel like we've set up this thing where retirement is this like swan dive, all or nothing, one-time irrevocable, extreme, life-changing event that we build up to. And we build it up so much that we basically say you should make a bunch of sacrifices in order to get there, to the point that, I've seen this in practice, like people that just stay in miserable jobs for years and years for the sole goal of trying to accumulate enough dollars to actually get to the point where they can tell their boss off, drop mic and exit and be done because they got enough money that they don't need to work anymore. And the phenomenon that I see for just one client after another, having done this for 20 years now, is that for a lot of people, retirement is not a natural state of being.
Absolutely.
We, just human beings, we need something to do when we wake up in the morning. Otherwise, we become kind of listless and aimless pretty quickly. It can outright lead to things like social isolation, depression, divorce rates rise when retirement happens. There's actually a lot of negatives that can happen if we don't have a support system, or at the most basic sense, a plan of what we're going to do, not just what we're retiring away from, but what we're retiring towards. And often we don't get a fully fleshed out vision of what we're going to retire towards, right? I hear things like, I'm going to play more golf. Like, awesome. With who? Oh, well, I got a couple of buddies who are retiring around when I do. Great. So after you've played with the same foursome 3 times a week for 6 months, and you've done 75 golf outings with the same guys and realize that you're going to be golfing with the same foursome another 400 times in the coming decade, and all the jokes are really old already. And it's like, okay, so what are you going to do with the next 29 and a half years of your retirement? We see a lot of people start having second thoughts, right? We build up retirement in this version of like it's a 30-year vacation. And, vacations work because they're vacations. Like, we vacate away from something, then we come back. Permanent vacations are not as fun as we think they're going to be in our heads. Like, just, the good and bad news of human beings. We are remarkably adaptive. So when times are bad, we can actually adapt our way down. And when times are good, we adapt our way up. And then we become dissatisfied from the thing that we wanted. So it's kind of cool. It creates human drive and productivity and progress and advancements and all sorts of cool things. It also can make retirement really boring and miserable if we don't have something to focus on. Now, some people find a passion in hobbies. My father retired and immersed himself into family genealogy. He's always been the family genealogist. When he retired, there were like 1,000 people on the family genealogy tree. Now there's like 25,000 people on the family genealogy tree, going back hundreds of years and branching forward across multiple countries. And he just hangs out in his days looking like online archives of foreign cemeteries. He loves it. It's his thing. More power to him. Now, others will retire and maybe they'll find passion in charitable work and nonprofit work, and somewhere where they give back to just a community or a world where they want to. Maybe that's giving back to a church or a synagogue. Maybe that's giving back to leadership development, community development. There are a lot of different ways that we can do it. But the interesting phenomenon I find is, for a non-trivial number of people, the thing they end out doing in retirement has economic value and they make some money. One of my early clients that I worked with, had a version of this. Like, she spent way longer in an unhappy job than she really wanted to. She finally managed to retire. She was a former engineer. 6 months in retirement, she got bored. She decided for a new creative endeavor. She started making window treatments. It's a hobby. Like, Debbie likes making window treatments. And she actually got so good at it that she started making about $15,000 to $20,000 a year selling handcrafted window treatments. Now, she made like a nice 6-figure income as an engineer. So like, this was a lot lower money than she was used to. But like, adding $20,000 a year to her income for the better part of 10 years of retirement is essentially like an extra $200,000 in her nest egg. If she'd realized she was going to add $200,000 to her nest egg, she could have stopped 5 years earlier. 5 years of a job she couldn't stand, trying to get to a point of a retirement that she realized 6 months in she was bored and found something productive to do that ended up making money anyways. So much that she didn't actually need to build up the way that she did. And it's a pattern that just, one of those things, like once you see a pattern, you see it everywhere and you can't stop seeing it because you're watching for it. Mm-hmm. It's a pattern that I see play out so often today, to the point that when we talk to retirees today, or even just people are thinking about retirement, the question I will always ask is just, what would you do with your time if it didn't matter how much you made? I'm not asking what you're going to do in retirement, because retirement is a loaded term of like, I don't work, so I guess I lounge around and maybe I like donate time or travel a lot or whatever. And hey, if that's your thing, more power to you. But what would you do with your time if the money didn't matter? And for a lot of people, they would still do a thing. Might be a productive thing that makes a little money. It might make a small fraction of what they made before. Sometimes it actually makes a decent amount of money compared to what they made before. Like maybe you're a professional and you're going to consult to your own industry. Maybe you've always wanted to do something entrepreneurial and you're going to go make a little side business. Maybe you're just going to take up a completely new career and second vocation that you're just not going to work the hours you did before, but you'll do some. Maybe you would even stay at your current company or job, just transfer into a completely different position. If I gave you permission to ask for an internal transfer to any job at your current company, making only a third of what you make, is there anything where you currently work that might actually be enjoyable? You can make a third of what you make and work a third or less the hours that you do. Is there anything you might want to do if you could craft that job for yourself? And what I find for so many people, the answer is actually yes. Now, you may have to sit down and think about it for a while because the gut impulse is like, what would I do if I didn't have to work? Like, tell my boss off and never go back there again, right? There are certainly plenty of people who live in that situation. So you got to free your mind a little to really say like, okay, so you did that. It feels better. But seriously, you got like 20, 30, 40 years to go on this earth. What are you going to wake up for after you take 3 or 6 months to chill out? And is the thing you might do actually have some economic productive potential? And what I find so often is that it does. And when you might do that for 5 or 10 or 15 years, even at a limited capacity, it's a non-trivial, often hundreds of thousands of dollars economic impact, and can be the difference between retiring today versus fighting it out for another 3 or 5 or 10 years in the first place. And so I think just it's crucial to be thinking about asking that question. Is what would you do with your time if it didn't matter how much you made? I'm not saying you don't make anything. It just doesn't matter how much you make. If it turns out it makes something awesome, if it turns out you pick a thing that doesn't make any money, that's okay too. But sometimes it does turn out to be a thing that makes money, and that actually changes the trajectory and the timing in really meaningful ways.
I've seen it in real planning with clients. The impact of even a few years of self-employment income can be massive. And it relates also, assuming that it's a resilient type of income in the context of the economy. It also helps to deal with that sequence of returns risk.
Absolutely.
We've talked about retirement. For savers, you wrote a paper in the Journal of Retirement, 2018, I think, about the non-constant growth rate of employment income or earnings over the life cycle. How does that impact the amount of someone's income that they should be saving throughout their working life?
Yeah, the traditional view of our working years is kind of, we do our job, we earn our income, we get our cost of living increases. Like maybe every now and then I'm going to get a raise. Don't necessarily want to count on it, but hopefully I'll get that promotion. But we largely project, saving for retirement as though like, here's what you earn. You're going to save a percentage of that. And just as we chug along, we're going to keep saving that percentage. And I'll guesstimate my retirement lifestyle based on the inflation adjusted changes to my salary over the next 5 or 10 or 20 years or whatever it is. What we actually see in practice, though, if you look at the broad-based economic research, is the idea that our income just lifts with inflation is not actually representative of what happens. And there's a couple of different cross effects that happen. The first is we get far more in earnings increases in our 20s and 30s than we do in our 40s and 50s. Right? It sort of makes sense when you think about it. It's like formative years of my career, I'm getting established in my job or my industry or whatever it is. Like, I make a lot more when I'm 10 or 20 years experience, particularly in a lot of professional services jobs than I do early on. Even a lot of traditional blue collar jobs, like we might go from worker to manager. Like there's a lot of promotions that tend to come in the early years, which means our income growth is disproportionately higher in our 20s and 30s than it is in our 40s and 50s. We usually at least keep the cost of living adjustments in our 40s and 50s, but big income growth that often happens in the early years. The significance of that is, on the one end, we have this tendency in our industry to these rules of thumb, like you should save 10% of your income or 20% of your income or whatever it is. without recognizing like that's fine if your income is just going to go in this straight line path over time. But if your income is going to ramp up quickly and then the income growth is going to slow later, the reality is trying to save like 20% of your income in your 20s when you're barely making enough to make ends meet in the first place and you haven't gotten the income lift years yet is like, it's just kind of a preposterous thing to suggest. Now, in practice, that's why most people don't do it. And most people in their 20s have very little savings. What really aggravates me about it, though, is we beat people up in their 20s and 30s and we make them feel so guilty about it that what I see is a lot of clients who will hit my radar screen by their 40s, who don't have a lot saved, who are ashamed they don't have a lot saved, who feel bad they don't have a lot saved, and may have even given up on the possibility of retiring and saving. Like, I know I've been supposed to be saving, but like I'm 42 and I've barely got anything saved after 20 years. I'm probably like a lost cause at this point. I appreciate, Ben, you taking me as a charity client. And the truth is like, you know what it means if you don't have a lot saved in your early 40s? You're normal. Like, almost no one can save a significant portion of their income in their 20s and 30s unless they happen to come out of the gate in a very high income job from the start. And so there are a couple of problems that come from this, right? Like we set, I think, unrealistic expectations for saving in our 20s and 30s. We beat people up about not doing it in their 20s and 30s. We can even teach people some kind of like learned helplessness that by the time they're in their 40s and the income actually gets a little better and their life stabilizes, they don't get excited about saving now that they've actually got the means to do so. Because like, hey, if I'm doomed anyways, I may as well buy the new car and the fancier house and the rest because apparently my retirement's already screwed. It's like, no, now you are getting to the point where you've got a decent car and a decent house. And now when you get a raise, save all that because you already got like a decent car and decent house. Like save all of that. And just in general, like I try to encourage people to think less about save a percentage of your income. You got to save 10 or 20% of your income and more like as your income grows, how about trying to save 50% of each raise? Right, I'm not going to beat you up for what you're not saving now, but just like when you get the next raise, when you get like the next $3,000 raise, just spend $1,500 of it and save the other $1,500. And if you do that through your 20s and 30s, if you approach it with that philosophy, by the time you get to your 40s, you'll notice you're saving a ton of money. Not because you saved money you couldn't save early on, but because as the income went up, you didn't get into this learned helplessness state of, well, I guess I can't figure out how to save 10 or 20% anyways. I may as well just go ahead and keep spending. Right. But say, no, as I'm getting raises, that's going to form my future spending base. So that by the time I'm in my 40s, I'm saving a lot, even though I wasn't saving a lot in my 20s because, hey, it's hard unless you get a really good job right out of the gate.
So, Michael, let's shift gears to the business of financial advice because your perspectives on this will be excellent. So you're involved with two very successful financial services businesses with very different fee models. First one is Buckingham Strategic Wealth, which we're friends with the people at Buckingham, and Larry Swedler was a guest on our show a couple of years ago. So Buckingham has a fee model similar to ours, which is based on assets under administration. And then you're also involved with XY Planning Network, which is a fee-for-service model that is not tied to assets, as I understand it. So how do you think investors should think how to choose between these two models when they're seeking advice?
Yeah, it's an interesting split, right? We've got sort of the assets under administration, assets under management model. And, as we broadly label it, fee-for-service models, sort of what does that mean in practice? Think like monthly subscription fees, financial planning advice for $100 or $200 or $300 a month or whatever the advisor charges, or maybe it's an annual retainer. But like not tied to portfolios or assets at all. Just sort of like, here's a list of services. Here's what I pay you on an ongoing basis on that, whether that's monthly or quarterly or annually or whatever it is. So, I'd kind of answer this in two ways about how consumers should think about this. Cause I really tend to actually start this from the advisor end about how advisors should think about this. And oversimplifying a little, like the way I encourage advisors to think about it is, look, the assets under management model works fine for people who have assets to manage, right? If I've got a retirement nest egg and I need some advice, And part of the advice includes someone to help me tend this nest egg that is crucial for my retirement. The assets under management model works great. Like, our interests are aligned. I want your portfolio to do well because it's how I get paid. You want your portfolio to do well because it's how you live and survive. I want to retain you as a client, to charge you an ongoing fee, which means I am highly incentivized to provide you lots of ongoing service and advice. And just there's a lot of just intrinsic positives to that model, which I think is why we're seeing it become certainly a dominant model here in the US over the past 20 years. And we're seeing it more broadly around the world. Just, it's sort of like, it's not the perfect model. There are caveats to it. There are challenges. It's sort of like I think it was the famous Churchill saying about democracy, like, it's the worst form of government except all others. Like, there are problems with the assets under management model, but it still, at the end of the day, is remarkably good at aligning. We all want your assets to do well. We want your nest egg to do well. We want to keep servicing you on an ongoing basis. We want to keep giving you value on an ongoing basis, because otherwise you will and should fire us. And frankly, it's kind of what I want for my service provider. I want you to always feel like you got a fire under you to keep giving me service, keep giving me value, and keep tending that nest egg I've given you to be responsible for. So I think it's very positive. But, and there's a huge but, it kind of doesn't work for like the 70, 80, 90% of the population that doesn't have enough assets to hand to an advisor to get advice in the first place. And I know this is a huge frustration and challenge that we see in the US marketplace. I believe it's similar in Canada as well, that that AUM model works fine for people who have some A to M, like they've gotten to that point. But if I just want to pay someone for some doggone advice, often it's difficult or outright impossible, because many of the firms that do that model actually have minimums. Like, if you don't have this much in assets, we can't work with you. We're not built to work with you. And so there are plenty of people who would happily pay an advisor if only there's an advisor who would just bill them for advice. And that to me is really the growth and the evolution of the fee-for-service model. I don't view it so much as like a choice model. Hey, you've got a pile of assets. Do you want to hire a fee-for-service advisor or an AUM advisor? Certainly, if you've got assets, you have that choice. But I see the growth and opportunity around the fee-for-service model for the other 70 or 80 or 90% of people who are like, look, I want an advisor and I value advice and I need advice, but like, either I don't have a pile of assets to manage, I don't want to give them to you because I'm actually comfortable with that part, need advice about other things. Or, my money's in other places. Like, I do real estate. I'm a business owner. I make new businesses. So like, I got a lot of financial advice needs, but I'm not selling my businesses and giving the money to you. I'm selling my business so I can make the next one, because that's what I do as a serial entrepreneur. And so I think the opportunity around fee-for-service models and why I'm so excited about them is just that, frankly, from our end, at least as advisors, and ultimately for the benefit of consumers, it makes the pie of advice bigger. I don't think the AUM model is broken, but it is by its nature very exclusionary to only the people who not even just already have wealth, but already have wealth accumulated in a certain manner. And not that those people don't need advice, they do, but like, there's a lot of other people that need advice as well.
Wow.
That just literally get excluded by the assets under management model and models with asset minimums. And so, we built a business called XY Planning Network that specifically champions this around financial planning for Gen X and Gen Y. That's the X and the Y, and the XY Planning Network name will have to be XYZ planning soon, now that Gen Z is coming into the workforce. Right? But just recognizing that there's a huge swath of people in their 20s, 30s, 40s, and 50s who maybe don't have significant retirement assets or don't have them available in a manner that an advisor could or would be able to manage. But they certainly have a lot of advice needs. Like, it's not like our lives are financially simple in our 20s, 30s, and 40s, and 50s. We just needed different models to be able to serve a wider range of clientele. And I think that's ultimately what we're creating with a fee-for-service model. And, in the US, we've taken it as far as not only do we build XY Planning Network to teach advisors how to do this, and we now have almost 1,200 firms that are doing this model in the US. But we also built a fintech company, a financial technology company called AdvicePay, that actually facilitates the payments because if advisors are going to do ongoing fees, like just you actually need a scalable way to collect and manage fees. Like as consumers, we don't like writing checks. And as business owners, we don't like handling a high volume of checks. Like it's a pain in the butt. Did you send the check? Where is it? I got to process the check. I got to deposit the check. I got to reconcile the check. Like just a very, very expensive manual process if you're going to do it for a lot of clients. But it's something that's eminently automatable with technology. And so the other thing that we actually did, at least in the US market, is we built this tech platform called AdvicePay just to handle the financial planning fee processing and tie it into existing financial planning software systems. And what we're finding is that is greatly expediting the growth of the new models.
Wow.
Because it's easier just administratively to do it. So the advisors who want to do it just have to go give advice and get paid for it.
Fascinating. Vanguard's personal advisor services, which is an AUM model, maybe more geared toward the people who have accumulated less or don't have as much in financial assets, like you were talking about, but still an AUM model. They're charging 30 basis points and decreasing for larger amounts of investable assets, plus the index fund MERs, obviously. And then we have Buckingham Strategic Wealth and firms like PWL on the other end of the spectrum, where we're charging more than 30 basis points for the advice and the asset management. How do you articulate the difference how do you articulate the difference between a service like Vanguard Personal Advisor Services and something like Buckingham?
So I'd answer that in probably two primary ways, essentially coming down to service and expertise. I love what Vanguard built and the service that they're offering and the people that they're reaching. But I'm also a business person. I've built a number of businesses over the years. Like I can do the math of how this works. Like this model only works when one advisor has hundreds of clients. And when we just get down to sort of brass tacks on numbers, like there's roughly 2,000 working hours in a year. Right, 40 hours a week times 50 weeks a year with a little bit of vacation. I can't actually be like productive game on with clients I'm working with for all of that. At best, I probably get like 50 to 60% of those hours that are really productive. So maybe 1,000 or 1,200 hours. So if I get 300 clients and 1,200 productive hours a year, like best case scenario, I get maybe 4 hours per client total. That's like meetings, in between meetings, quick phone call, hot email in, whatever it is. Like, hey, you want to sit down and do an annual review meeting that takes an hour and a half because you got some stuff going on with your life. That meeting plus the prep for that meeting plus the follow-up for that meeting, you probably blew out 70 or 80% of your advice service opportunity in one meeting, one thing that came up. So I really hope nothing else happens in your life this year. Now, to be fair for their service, they don't like literally cut you off at the 3 or 4 hour mark. They try to average this out across a large number of advisors, but they're not exactly built to give a whole bunch of proactive phone calls and outreach and service support, because if they do it and you say, yes, I need your help, they don't have the hours to do it. When we look at what happens in firms at the other end of the spectrum, so Buckingham, firms like PWL, I don't know your numbers exactly, but what we see for most firms in that context are things like 80 clients to an advisor, 100 clients to an advisor. Some firms do 120. Some firms that are even higher touch might only have 50 or 60 clients per advisor. And so now suddenly, instead of saying, you get 3 or 4 hours a year with me, including all meetings, all prep, all between and everything, now suddenly we're in a world like, no, you got like 20 to 30 hours per year with your advisor. So like, you got a complex situation with your family where you need advice and we got to go back and forth and bring a lawyer in and deal with all this stuff about how are you going to carve up the family business amongst your kids, 2 of which want to be in the business and 1 doesn't. Like, I got the time for that. Like, we're here for that. And so just the service and very literally how service hours translate into how many hours of time you get engaging with an advisor for advice, and sort of the like, I know everybody always thinks I'm guilty of this as well. Like anytime I call my attorney or accountants, like I got a quick question. It's going to be simple, right? Because we always say that because I want to manage down my hourly rate. But like most of our problems don't actually turn out to be that simple. If it was that simple, I would have solved it with the internet and not be calling my attorney or accountant. Or like by the time it gets that phone call, it's usually actually complex and it's going to take some time. And so having an advice relationship where you can get the time you need to solve the problems when they happen really matters.
So to that point, Michael, if someone's listening and they've decided they want a higher touch type relationship with someone like Buckingham or our firm, with your experience and your knowledge about the business, like I can imagine someone saying, okay, what should I really be looking for? Everyone says similar things on their website, but what are some of the tips if you're listening now and want an advisor that they should be looking for in a new financial advice relationship?
So there are a couple of things I would suggest. One that I actually think is a good one is, how many clients do you work with in addition to me? And depending on who you talk to, and they might be newer or kind of gearing up. So like, how many clients do you plan to work with when you're at capacity? Because they might not be full yet. Technically, if they were full, they wouldn't be talking to you. So presumably they're adding more, which means they're not at the end of their journey. How many clients do you plan to be working with at capacity? Right? The people that answer 2 to 3 to 400 are going to have a very different level of service and focus than the people who say 120, 180, 60, 50. I mean, there are some firms that work with ultra high net worth folks I know where like one advisor is completely booked because he has 8 clients. How many clients will you be working with when you're at capacity? And there's really sort of 2 things to note with this. One, you can sort of do the rough math in your head, divide their client count by 100 by 12 into 1,200, and you're going to get about how many hours of service you're going to get out of that firm for the year. Give or take a little, but it's actually a decent rule of thumb approximation. The second thing you'll find around it, and just sort of the reality of humans. So there was it's an interesting line of research out there by a guy named Robin Dunbar, who found that species of all types, humans and others, we all assemble in some kinds of groups, essentially our herds. And you can actually predict the size of a herd by a particular part of the brain, like a particular physiological section of the brain. And so species that have smaller sections of this brain might only commonly organize in groups of 10 or 20 or 30. Species that have really large portions of this brain might organize in groups of 3 or 4 or 500, right? Think like giant flocks of birds. The particular size of this brain for human beings correlates to a herd group of about 150. It's essentially the number of relationships our brains can hold before we just lose track of who's who. And like, you the one that retired recently? Like, are you the one with the kids who went off to college? Or like just remember, like when you get one step closer from distant acquaintance, you get in like, when I say I know that person, you can only keep track of so many. That limit appears to be around 150. And it's why, even when you look historically, like there are remote tribes that the anthropologists study that consistently break apart into new villages when they get to about 150 people. Right? That was just when they found their social system starts to break down. The military units have had a common unit size of about 150 to 160 going back for literally 2,000 years. And even when you look at the research, the average person on Facebook has something like 162 friends. It's just kind of how our brains are wired of how many people we can keep track of. So the significance of this in the context of the financial advisor world is if you really want a relationship with an advisor, like they who know who you are, they remember your situation, right? Because I don't want to keep re-explaining myself and my situation and the stuff I'm going through. Like I hired you and I pay you all this money because I want you to know who I am. First of all, they better not be over 150 clients per advisor, because their brain's just literally not going to be able to hold it unless they're one of the super people who just happens to be particularly good at this. And realistically, it's going to get hard if they're over 100, because clients aren't the only people they know. They probably have like friends, family, personal relationships, all of which occupies some of the space in that brain. And so in addition to just understanding kind of how many clients will the advisor work with from sort of a capacity and how many hours of service will you get, there's a very real breaking point that if you're talking to an advisor where full is materially higher than about 75 to 100 clients, the odds they actually really know and remember who you are is going to drop off very significantly. Not impossible. Some people are kind of savants at this and they can have giant networks, but your odds are not good once they're getting a lot higher than about 75 to 100 clients per advisor.
That's fascinating. So, Michael, you're probably the best person in the world to ask this question to. And I'm not kidding when I say that. From the consumer's perspective, what industry, what financial services industry trends do you think that the average investor, the consumer of financial services, should be aware of that you see coming over the next, decade?
So I think the most fundamental shift that's happening across our entire financial services industry and even really happening globally, although different countries are getting there in a slightly different way and a different pace. The truth at the end of the day, so almost every developed country around the world, their financial services system has two segments of people. One are the people that make the financial system work. Like at brokerage firms, investment banks, the companies that make like the traditional financial system capital formation thing happen. Or like if I'm a company and I need to raise $10 million, right? I'm going to go back like 100 years ago. Like if I need to raise $10 million to build a railroad out to the western side of the country, and I don't know a person who can lend me $10 million, that was a lot of money back then. Like, what do? I go to a brokerage firm and investment bank and I say, I need to raise $10 million. So I'm going to issue 10 million $1 shares. And y'all got to find individual investors to sell my 10 million shares to at $1 a piece so that I can get the money to go build the railroad. Like the purest sense of public market capital formation that makes the economic system work. And in order to do that, I need a brokerage firm and investment bank that could underwrite that, get the stock sold into initial investors, and then facilitate a secondary market, what we just now call the stock market. Because if I buy your stock initially, I need a way to sell it someday, which means I need other investors to sell it to and a marketplace to sell it in. And so we have the side of the industry that essentially facilitates capital formation, the operation of public markets, generally like broker dealers, banks, investment banks. We have slightly different labels in different countries, but like that segment. Then there's a second group. The second group are broadly the people who get paid to give advice. Historically, in most countries, they gave advice by managing portfolios. And they usually derive from investment management advice divisions, although these days they've gotten much broader and the advice increasingly is more holistic than just the portfolio. But it's one of the reasons why that AUM model is so dominant. But in essence, we had two groups. The ones whose job was capital formation and the distribution of investment products, they were salespeople. Because like, if my railroad's going to raise money, someone has to actually sell the investor on buying my railroad stock. And then on the other side, we had the people who were in the business of advice and were regulated as advisors. And the challenge that's happened over the past 30 to 40 years or so is technology has increasingly automated all the stuff that the brokerage side of the world used to do. Right, 40 years ago, if I wanted to buy or sell a stock, I'd call it a stock broker who hopefully, if they were a good broker, had a buddy on the trading floor who could execute my stock at a slightly better price than someone else. Now, like if I want to buy a stock, I go to a .com website, I click a button, magic happens, and apparently I own a stock because an electronic screen tells me I do. Like we've completely decentralized the process away from the humans and just made it all happen with technology at 1/1000th of the cost of what it used to be. And what's happened in the process is that a giant swath of the people that used to be in the business of selling investment products no longer really get paid to sell investment products because you can buy all this stuff basically through the internet. And so what the brokerage industry has largely done around the world is they've said, well, consumers want more from us. We're going to start giving advice. Like, you can get the products anywhere. I'm going to give you advice. Frankly, the advice is usually pretty helpful at convincing people to buy the products anyways. Like, I'll show you why you need a product and then I'll sell it to you. But that's kind of a conflict in, if I go to the butcher, it turns out he always thinks meat is the best thing to have on the menu, right? Like, might give advice about which cut of meat to buy, but I know I'm going to get a certain recommendation when I go to the butcher about what my dinner should be. The challenge now that's happened around the world is the broker capital formation side of the industry has largely verged into the advice side of the industry, while the actual advice side of the industry is still doing advice as well. And the two are mashing together because technology forced them to converge. And it's creating, on the one hand, an absurd amount of consumer confusion, right? People that write financial advisor on their business card, and some are literally in the business of advice, and some are legally in the business of product sales and happen to have figured out that advice is good at selling products, but it's not objective advice because it's there to sell a product. And now we're even seeing a regulatory backlash of regulators that are coming forth in one country after another and saying, wait. If y'all are going to call yourselves advisors and give advice regardless of what portion of the industry you're in, we're going to regulate you like advisors, regardless of what portion of the industry you're in. And so you see fiduciary rules, best interest rules, at least new disclosure rules. The UK and Australia have put full fiduciary rules in place. I know you guys have legislation called CRM2. We have a version of it called regulation best interest. Neither of ours have gotten quite to this full advice regulation yet, but we're all moving this direction because of this convergence. Now, in the near term, the problem for consumers is it's not enough that someone says they're a financial advisor. You actually have to clarify, like, do you represent a certain company's products? Do you get paid because of the implementation at the end, like the butcher when they sell the meat? Or do you actually get paid to give me the advice, like the nutritionist who just tells me what's healthy for me to eat because they're getting paid for nutrition advice, not getting paid to sell meat? The good news of it, though, is I don't think we're going to be fighting this fight much longer. Like, the regulators have largely noticed these channels have converged. And, the truth at the end of the day is we've only ever regulated advice to the highest standard. It's sort of in the definition of advice. Like, it has to be for the person you're giving advice to. That's what makes it advice, not a sales pitch. So right now, I think there's a kind of a mess of this in a lot of countries around the world. But I do think we're structurally reorganizing it. A lot of people in the brokerage firms in practice are already doing it because, like, giving good advice is good business. But I think the good news for the average investor is that you're going to see the quality of advice lift a lot over the next 10 years because the regulators increasingly are regulating everybody of advice, which means higher standards of care, higher standards of conduct, higher standards of just education. In the US, the actual bar to be a financial advisor requires no degrees, no designation, no education, just a very simple 2-hour regulatory exam. And that stuff, I think, is going to change dramatically in the coming decade. And just ultimately that lifts the bar for our industry, which I think is long overdue, and ultimately lifts the bar and quality of advice for consumers. It means when you hire someone who says they're an advisor, it will be increasingly likely they actually are.
What a great answer. Michael, our last question for you is actually inspired by how you always end your podcast. And I've heard you ask this question well over 150 times now. How do you define success in your life?
So success for me is really kind of an impact drive. I guess some people sort of frame it as leave the world in a better place than what it was when you came to it. Mark Andreessen, who's a famous venture capitalist, talks about entrepreneurs who try to make a dent in the universe. Like, you can't reshape the whole universe. Maybe if you have a really good impact, you can actually make a dent in the universe. I view what we do as financial advisors as a sacred duty. And I don't say that lightly or to be campy about it. I remember when I first started 20 plus years ago with basically no training and experience whatsoever. I was a psych major theater minor who landed in a financial advisor job because someone would hire me, giving people advice about their life savings. And I didn't know anything about anything at the end of the day. And for me, frankly, it scared the heck out of me. Like, in about 40 minutes of that advice, I can destroy someone's 40 years of hard effort in accumulation. Like, we should treat that as a sacred duty. I mean, down to the fact that, the harm we can cause from bad advice, just the actual reality, like money is a leading cause of divorce, is a major cause of depression and suicide. Like, the stuff we deal with has really weighty, real world ramifications when you do it wrong, as well as huge benefits when you help people do it right. And so on the one hand, that's part of why a lot of my passion is around lifting standards for the industry overall. And I spend a lot of time on those sorts of issues, as well as teaching, training advisors. We have a whole website, kitces.com, that's just built for teaching and training advisors and trying to advance the profession. But what it comes down to for me is, as we said earlier, like a good financial advisor at capacity has maybe 100 clients, right? It's hard to do more than that. You lose track of them. And so when I look at our platform and I see, like tens of thousands of advisors that come to the site every week to learn how to be better, like that gets me really excited. Like that's a couple of football stadiums full of people that we're directly impacting every week. And because they each may have their 100 clients and we get that 100x multiplier, it's not just that we might reach 50 or 60,000 advisors in a week. It's that what we taught them could positively impact 5 million people.
Absolutely.
And I will literally try to envision 5 million people in my head, which is a lot of people and it's kind of hard to wrap your head around, but that's actually the point. Like, that's what gets me sort of up and excited in the morning to do the work that I do. And ultimately, I define success by the reach and impact we have in moving that needle. How many advisors are we reaching, which is easy to measure, and how much impact are we having in lifting standards and the quality of advice across the whole industry, which is a little harder to measure in practice. But when we look at just new models we've created with XY Planning Network, shifting in models with AdvicePay, a lot of what we do into teaching and training advisors, the sheer number of continuing education credits we give to advisors every year, which is tens of thousands of hours of education. Like that's the kind of impact stuff that gets me really excited, and how I look at success for the work that we do.
What an amazing answer. I mean, Ben and I both know many advisors, and everyone listens to your podcast every week. Everyone knows who you are. So certainly you're having a massive impact every single week. I don't miss an episode. And this has been a real privilege to get a chance to introduce you to our audience. So Michael, thank you very much for your time.
My pleasure. Thank you.
Thanks, Michael.
Absolutely. Thank you, Ben.